Heavy is the head that has to manage all of this.
Hey everyone, welcome back to my channel.
We're now incentivized to buy what we already buy.
Fumbling through college had me building.
I also got some done on the other side.
And that was right around, I would say, May, maybe right before renewing the lease for this property.
Welcome to the channel, Martha.
Thank you for having me here.
Oh, I was going to say, I am getting up there in age, I'll tell you what.
Bills paid by other people, life was never this good. I had to step back, knowing that it's...
Hey everyone, welcome back to the channel. So today we're going to talk about a little bit of a housing market update in the Midwest. What is going on after the interest rates have dropped by 50 basis points, and what you should be doing right now to prepare for these amazing opportunities that's coming not only at the end of this year, but in 2025 and 2026 as well. So right now, the Fed has dropped interest rates by 50 basis points. So what that does is that allows the banks to lend money at a lower rate by basically half a point. So that's going to allow the banks to stop dishing out 5% high yield savings accounts. They're going to drop that down to 4.5%, maybe even 4%. And that's going to incentivize some people to either invest in the stock market or simply start to spend money, right? And so as a consumer or as an investor, you want to be looking at where is the best place for your money now versus previously, because previously it was okay to get a 4.5%, maybe even a 5% interest rate on your savings account with zero risk at all, right? And it's FDIC insured. But now that interest rates are dropping, the bank is not incentivized to pay you as much, and therefore you will be paid less. So it is more advantageous for you to either invest in the stock market or to start to spend that money. Now, real estate, everyone expected to just soar up as the interest rates dropped. But instead, what I'm seeing right here in the Midwest is that prices on real estate property are still falling little by little while the interest rate drops, making it a little bit more edible for the average investor or the average home buyer to go out there and buy a home today. So the Fed has already stated that they plan to drop another 2 points by 2026 and at least another quarter point by the end of this year in 2024. So with that being said, we want to be aware of, what we are capable of managing, right? If you're able to buy now and then refinance at a lower rate in 2026, that will be more advantageous for you, because we don't know whether or not inflation will start to rear its ugly head again, and then everyone else is going to be forced to basically adapt to the higher mortgage rates, right? So you want to be able to buy when it is affordable for you, and then drastically drop your rate come 2026 if the Fed keeps to its promise and drops the rate by at least 2 points. That should put mortgages right around 4.5% and maybe even 4% if you use points and buy down your rate. Now, some people might be asking, what is a point buy down, or how do you buy down your rate, and why would you want to do that? So when I first started getting into real estate, I was super upset when I was told by my mortgage lender to buy down my rate. But the truth is, I didn't know what that meant, and I felt like they were trying to get one over on me, because I assumed that should have been baked in. I assumed that I should have just been given the lower rate. But in fact, the bank has to make a profit on the closing costs. They have to make a profit by lending you out this loan, because you can refinance, you can decide to switch lenders. There are so many factors involved. With the home, you might even decide to sell, and now the bank loses that loan entirely and all the interest that would have been paid on it. And so every bank has something called par pricing, and that is when the price of the home has a set rate where the bank isn't adding any additional fees or hidden costs. At this point, when you're looking at the par pricing, you're looking at the bank's starting interest rate versus their closing costs and all the fees associated with choosing them as a lender. Every bank has a different par pricing, and as you buy down with points, you can determine whether or not the closing cost is a good fit for you. So for example, one bank might say, in order to get a 4% rate from 4.5, you're going to need to pay $10,000 additional in points. Another bank might say it is $7,500 for the additional points. Now, based on all their fees, there might only be a $500 difference. And so you might decide to still go with the more expensive bank because you like their services and their network. Or it might be a $2,500 difference if everything was the same except for the point buy down. And then you're going to want to go with the cheaper alternative that gives you $2,500 off. And so a lot of people make the mistake of saying, hey, what is the interest rate that you're providing me today? When a bank is actually able to give you any interest rate you want as long as you're able to buy it down with points. And so you want to ask, what is the cost associated with this rate? Because that is going to be more of an experienced conversation, right? Once you understand the cost associated with the rate, you can then determine how much are you paying for the interest rate that you're receiving. And then you can figure out which bank is going to offer you the best interest rate with the best cost as well. So if you like this video and this quick analysis and breakdown, if you have any questions, comments, or concerns, please feel free to reach out to me in the comment section down below. You know that I post every single day at 8 a.m. daily on YouTube, Rumble, and Spotify for podcasters. And I can't wait to see you in the next one. Peace.